Good afternoon. This is Jim Perry at Perry Capital in Miami. I'm not in Miami, I'm in Chicago. It's a snowy Chicago, Groundhog Day, and ironically, the government's talking about another government shutdown. The irony is just too rich. Bill Murray has to be laughing. He's from Chicago. Anyway, today we're going to talk about the economy. We're going to talk about where it's going. It's doing much better than people expected a year ago. Continues to do well. The stock market obviously continues to knock up against all-time highs. The Dow is up another 1% today, above 49,000, and the S&P is closing in on that 7,000 number again, as it did last week. So very close to all-time highs. Meanwhile, the markets are going sideways and have been since about October. So investors, they do have concerns. I would like to talk about those concerns as we go into the year and why maybe they're not quite as bad as some people think. We're going to talk about the markets, earnings, and a forecast for the year. So let's get started. Economics. Let's talk about the Fed, because the Fed drives rates and rates drive everything. We have a new Fed head. That's Kevin Warsh. He will preside over his first policy meeting on June 17th of this year. Until then, through May, we have Mr. Powell. Expect no rate cuts between now and May, but expect some more stimulus, probably a rate cut or two or three in the second half of 2026. We had 3 rate cuts in 24. We had 3 rate cuts in 25. Let's just call it 3 rate cuts in 26. Starting in about June. This is why the stock market remains at all-time highs. That and the fact that the economy is actually doing quite well. The Cities Surprise Index is at a 3-year high. That came in today. Virtually every series of data, hard or soft, is beating expectations at surveys in places like Bloomberg and CNBC and the Wall Street Journal. The economy is actually doing quite well. As expected, we talked about this a year ago. I expect the same to continue. Why? The labor market's at all-time highs and wages are rising. Yes, affordability is a problem, but if we get that balance sheet down and that budget deficit down, inflation expectations are going to fall. I do expect a deflationary economy in the years ahead, and I expect an expansionary economy in the years ahead. Why? Corporate America is doing well. Q3 numbers, we'll talk about it in the next section, but profit margins all-time highs, revenues all-time highs, and profitability all-time highs. So that's why the market's here. I expect more in the quarters ahead, and we'll talk about the markets in a minute. The S&P 500 returned 16.6% last year. That's about the average over the last 16 years, the low being 2009 after the great financial crisis. It's been an extraordinary run. I expect it to continue next year and maybe the year after that. The reason is because the conditions that got us here remain in place. Those conditions, there are 3. Global money supply and domestic money supply continue to expand aggressively. Central bank balance sheets, particularly the Fed's, continue to expand and provide inflationary backdrops and liquidity to the economy. And number 3, which is unique to every presidential cycle, is that the administration will do everything in its power to spend money on the fiscal side to try to maintain power, especially in the House of Representatives into the midterm elections. Investors are comfortable with risk. You wouldn't know it by listening to the news, but earnings per share are doing extraordinarily well. I also read this weekend that profit margins at the S&P 500 level are running at 13.2%, which, if maintained through the reporting season, will be the highest profit margins in the history of the U.S. stock market. Revenues are growing at about 8 to 10%, and earnings per share profitability running at about 10% at the S&P level, maybe 12. And in the information technology sector, earnings in that sector are running at 30%. Perry Capital is overweight technology and defense. Those sectors will continue to drive the U.S. economy, and the consumer will continue to drive GDP. It looks like it's going to be a good year. If we get a little bit of a downtrade first, pay attention to the signals and look to put some money in on some weakness. Okay? Thanks a lot. Have a good first quarter, a good first half, and a good year.